Well, good morning. Today we have a special guest on The View, Oscar King. I'll introduce Oscar in a minute, but John Abernathy is off sick, and I take this opportunity to wish him a speedy recovery. Oscar, it's a great pleasure to have you on The View. I think you've been on before. Oscar is an investment analyst with Clime, located in the Melbourne office. Oscar, tell us a little bit about your role and responsibilities at Clime.
Thank you, Paul. It's actually, my first time on The View, so making the debut today. And thank you very much for having me on. So as you mentioned, my role at Clime is an investment analyst. So my roles and responsibilities relate to gathering insights on sectors within my coverage and providing them back to the team on an ongoing basis so we can make the best informed decisions. So on that basis, my roles and responsibilities more relate to 3 or 4 sectors. So I spend majority of my time looking at consumer discretionary, information technology, more recently industrials, and then also the online classifieds. So these businesses like REA.com and Seek and car sales and those sorts of things as well. So yeah, the majority of my time is quite broad based, but we do try and narrow that focus into a few sectors so we can become those industry experts and provide those insights to the team so we can make those best informed decisions.
Okay, so that's terrific. So we'll drill down into that in a moment, but I thought I'd just start off by kind of summarizing the narrative about the market that John and I have been talking about probably for 6 months, which is that markets appear a little bit pricey at the moment. So, for example, the ASX is on a price earnings ratio of around 17 compared to a long-term average of about 15. In the US, the prospective PE is around 21 compared to a long-term average of about 17. And we've justified these prices on the basis that we expect interest rates to fall and earnings to grow. And certainly in the United States, the economic data has been surprising on the upside, not so much in Australia. Is that how you generally see the market, the macro environment, if you like, at the moment?
Yeah, definitely. I think that we're at an interesting juncture, I think, in markets. And look, it's been a fantastic run over the last 12 months, especially in global equity markets, more so in the US than, say, Australia, just given the bias towards technology names and so forth, on the basis that we have seen, we've talked about rate cuts, we've talked about how much has been going to be priced in by the market. And more recently, we've obviously seen economic data in the US continue to surprise to the upside, and that strength really coming through. And Jerome Powell recently at his conference was saying that perhaps we can wait a little bit longer, and the market is now repricing that once again. So it sort of seems like we're in that no man's land from the macro perspective, where bond yields are now on the rise. They're back towards those all-time highs over the last 10 years, with the US at around, or the US 10-year around 4.6%. The Aussie 10-year Treasury yields obviously risen as well, in sympathy. And on that basis, we are of the view that, rate cuts will come, but it is a question of how many will come in 2024. And the comfort for investors is that we were talking about 6 to 12 months ago, while inflation is out of control, we don't know when it's going to stop. But the positive thing is that inflation is coming down. It's just that last hurdle of getting back into that 2 to 3% band, which the Fed has talked about, and therefore triggering the release of the rate cuts potentially later this year in 2024, which remains our base case. The one thing that I guess that is a little bit different and more positive for markets is that earnings momentum has really come through. Look at the earnings momentums in the US. Obviously, there's been a lot of hype around AI technology and what that is doing. but you are really seeing that earnings momentum come through for the overall market. And for the S&P 500, when we look 2 years out, it's around an 11% jump from February to where we are today. For the ASX, it's less so, it's around a 9% increase. So whilst the overall arching thesis is that, you know, inflation is going to be difficult to bring down, it's heading in the right direction, rate cuts will come, and overall, that's a positive environment for equities in our view.
Yeah. Some great insights there, Oscar. Thank you. Let's return to Australia with some specific sector questions. You mentioned that you look at consumer discretionary. Perhaps you can differentiate that from the consumer staples market, which seems to be the focus of a Senate inquiry at the moment. But tell us about how you see the consumer in Australia, and how you go about getting insights about the companies that are dependent on consumers, and what your thoughts are there.
Yeah, absolutely. So the consumer, it's a very broad sector, so it definitely keeps me busy and where I spend the majority of my time, whereas the IT sector, there's not a huge handful of companies, but within consumer, you know, you've got a very broad-based sector analysis within the sub-segments of that. So you've got specialty retailers like JB Hi-Fi, Wesfarmers. You've got your travel companies, so businesses like Flight Centre, or consumer services businesses like Aristocrat, all the way down to product specialists like Breville, and then you have car or auto groups like ARB or GUD Holdings. So when we think about each of those subsegments, over the past few years, we've had very different influences, and it's been impacted by the likes of COVID, which obviously triggered everyone to work from home, which pulled forward a lot of spending towards technology goods, upgrading your houses from renovations, these sort of factors. And we've really seen that in the retail sales data, essentially from ABS, or the Australian Bureau of Statistics. And more recently, what we're actually seeing is over the past few years is that we've had the TVs and the toilet paper stages at the very beginning, where we saw the hoarding, and then we saw the TVs coming through fueled by this massive stimulus. But the stage that we're in now is more or less in towards this travel stage. It's towards services. It's that rebound that we've seen, that once the floodgates of whether it's the borders opening or whatever it may be, investors and consumers have started to push towards those sort of investments, and also those styled companies, whether it's out in the street spending your money at a cafe, or whether you're booking a flight on Qantas or booking a flight through Flight Centre to get over to Europe. So it's definitely something that we are witnessing. Now, the one thing that we are cognizant, or have been cognizant, is that everyone has been pricing in a recession. The recession was the most anticipated recession in history, and it never eventuated. So yeah, that's the one thing where the market got it wrong. And, you know, the market was pricing in the fact that we have these record high interest rates, we have record high inflation. It was going to squeeze the consumer. It was going to squeeze those consumers on that mortgage rate belt. But ultimately, consumers have done okay. They've actually weathered the storm better than expected. And, you know, when we look at underneath the hood, what's actually driving that? Well, there's probably a few key things that I would point out. And the first one would be immigration and population growth in Australia has been very strong. It was around 2.6% last year, largely driven by that immigration factor when we did have the borders reopen.
But that's 600,000 people over the last 2 years. Yeah,
exactly. It's a big... And, you know, there is a caveat to that. It's a double-edged sword. It's very positive for overall consumer spending, because more people in our country lift the overall rising tide of the aggregate amount of money spent in our economy. But it also puts pressure on housing, and also puts pressure on rental. And we've seen that come through in the inflation numbers. So there's a little bit of to and froing in that aggregate. But then when you overlay another aspect, which is real disposable household income, that is actually expected to improve from here. We've got declining inflation. We've got stage 3 tax cuts expected to come through later this year. And then you also overlay wages growth as well. So when we compile those 2 or 3 key drivers, plus unemployment rate at a very low level relative to history, and albeit it is expected to rise based on the RBA forecast to around 4.2% versus the average of around 6.2% over a long time span, over the last 20 years. That provides a very positive outlook in our view for consumer companies. And we saw that in the February results. A lot of companies reported better than expected margins. It's really starting to flow through as freight rates come down. You're actually managing those higher prices better. So consumers are still paying those higher prices when they put through inflationary costs. And then you get the upside from the fact that you get declining freight coming through as well. So margins are expanding.
Yeah. So, Oscar, in your examination of the sector, do you actually go out and meet company management? And perhaps you can give us some insights into a few of those reviews that you've done and what your takeout is.
Yeah, sure. So, as I mentioned at the beginning, part of the role and responsibility is to go out and gather the insights. So whether that's, browsing the internet or, reading through research reports, but a lot of the gold is actually going out and visiting companies and actually experiencing, what's actually happening on the ground and putting your ear to the ground to see the feedback from consumers. And I guess a prime example more recently would be going out and meeting with Domino's Pizza. It's a high quality growth stock. It's been very well managed over a long period of time. However, at the moment it is struggling, going through some growth pains as it overexpanded its store rollout internationally, and ultimately store profitability just hasn't hit as it entered new markets like Japan, and products, whether it's pizza or these new tailored sort of menu items, aren't really meeting consumer expectations. And then you overlay this inflationary aspect as well, it does put a squeeze on profit margins. So when you go out and meet these companies, and whilst it's all well and good that share prices may underperform in the short term, what we're looking for is what are the turning points in those businesses where they actually are starting to look pretty interesting. And Domino's is certainly one that we've got on our radar. It may be that it needs a little bit longer in the oven, as we like to say, but it's definitely one that we're doing a little bit more research on, and following a recent meeting with management, we do have more confidence in terms of those turning points.
Oscar, if I would, we've probably only got time for one or two more questions, but if I would invite you to select one or two other companies where you've got some insights, either which we've invested in or looking at closely. Anything come to mind that you'd like to share with the audience?
Yeah, sure. So there's probably two that come to mind, and the one that we've done a lot of work on is Light & Wonder. It's a gaming stock. It's a leading designer and developer of games across land-based, iGaming, and then also social casinos. So people may be familiar with the likes of Aristocrat, which is a market leader in the space, particularly in the US, which is the Holy Grail market. And this actually became apparent to us by doing the research on Aristocrat. We've held Aristocrat for a very long time, but the opportunity came about is that they actually listed a CDI or a CHESS depository share on the Australian stock market, which gave us as Australian investors access to foreign listed companies. So Light & Wonder is originally listed on the NASDAQ, but what this opportunity unveiled is that you've got a massive turnaround story, and this fits one of our value buckets at Clime. And what we look for is a turnaround story. So what is the turnaround story? Well, you had a balance sheet that was very constrained by high net debt to EBITDA. It peaked at around 11 times net debt to EBITDA. And COVID essentially created this catalyst moment where the board actually had to review operations and say, hey, look, we're really struggling here. People can't go into casinos. They can't use our products. What are we going to do? We need to deleverage. So what they did was they actually sold off their sports betting and iLottery businesses, and that enabled them to deleverage their balance sheet and start reinvesting that money into their key focuses, which is land-based products, so casino slots, iGaming, and then social slots as well. The second hurdle that you look for in a turnaround story is a refresh board. So Light and Wonder was very constrained by a controlling stakeholder, Ronald Perelman. He had about 40% stake in Light and Wonder, or it used to be called Scientific Games. He was then ousted. Essentially, he decided to exit from the business. He sold his shares to Jamie Odell, which once again, people may be familiar. He was the CEO and led the turnaround at Aristocrat from that early stage in 2006. And essentially what that enabled is Jamie and the rest of the board brought in ex-Aristocrat management, people that have done it before, people that have been in the industry for long periods of time and have a long history of execution. And ultimately what we're seeing now is that the rubber is meeting the road. You're seeing the improvement in terms of ROE. It's jumped massively over the last the year, and also expected to improve from here on out based on our analysis, and also the data and insights that we're seeing from consumers in terms of gaming performance, which ultimately is the driver of this stock moving forwards.
That's a really interesting story. So that's Light and Wonder. Anything else before we go?
Yeah, the last one would be GQG Partners. So it's a little bit of a left of field one, but it may be one that people are familiar with. It may not be, but GQG is a listed fund manager on the ASX. It's once again a CHESS depository share, so it's based in the US. It has over $100 billion of FUM under management, a boutique style fund manager where they can be more nimble and access these investment insights across whether it's India, whether it's the Middle East, whether it's the US, and really utilize the resources that they have to scale up their business. So they have 4 strategies. They've got an international strategy, they've got a global strategy, a US strategy, and an emerging market strategy. And what we're really seeing over the past 12 months is that the momentum coming through from FUM inflow and investment performance, which ultimately is the key driver of earnings. Having worked, well, as we work in a funds management business, we ultimately know what the key driver of performance is. And for earnings, this is investment performance. So if investment performance is positive, FUM flow should be positive. So GQG is really leveraging the fact that they've got a strong record of alpha outperformance versus their benchmarks. They have this over every single time frame for every strategy, which is a very rare thing to see within the market. Yeah. And they've got the ability to then take that to market across whether it's wholesale or institutional and really grow that book of FUM and therefore their earnings and valuation as well. So,
and Oscar, how does it compare in value to some of the fund managers that we'd be more familiar with, like Magellan or Platinum?
Yeah, so this is part of the investment thesis as well, which we think is really important. GQG has historically traded at a discount to the average fund manager on the ASX. So the average fund manager on the ASX over the next 12 months, so businesses like Janus Henderson, Perpetual, Platinum, your MFGs, have about a price to earnings ratio of 11.6 times. Now, GQG is around 11.2 times based on our estimated FY24 earnings. But we really think that this is a re-rating opportunity where you have strong investment performance, you have positive net fund flows, which is outperforming their peers, to then re-leverage or re-rate the business to trade at a premium to the market. So if that was to occur, we think that there's a strong re-rate opportunity underlying the earnings momentum that's already there. And then if we overlay our positive outlook for equities as well, GQG being a beta business or a mark-to-market business, it has positive underlying flows to the overall market too. So it should get an additional leverage boost there, which we continue to the upside.
That's fantastic. Really, really interesting discussion. Oscar, it's been such a pleasure having you on as a guest to The View, and I'm sure we'll have another opportunity sometime in the future. But that's all we have time for. To our audience out there, all the very best, and we look forward to seeing you next week. Thanks, Oscar.
Thank you. Bye.